Hey, welcome to another market update. My name is Steve Zahnd from the Zahnd Team Real Estate Advisors. Today is May the 4th, so May the 4th be with you. All right, let's do a couple of things today. We're going to do a brief macroeconomic overview and how that affects the real estate market. We're going to do a Q1 2023 summary and compare that to Q4 of 2022. And we're going to wrap up the month of April as well and show you the month-over-month trends. So that's essentially what we're going to be covering today. So sit back, relax, and enjoy the market update. All right, so now let's do a macroeconomic overview, and we're going to kick off with a couple key dates and numbers. First thing we're going to talk about is when the Bank of Canada is meeting next for its key policy rate discussion. That's going to happen on June 7th. The last two times the Bank of Canada came together, they held the key policy rate at 4.5%. So essentially what a big bank does is they add interest rate points to that key policy rate. So BMO, BMO, RBC, Scotiabank, etc., CIBC, they will add interest rates to that key policy rate. And right now, their prime rate is 6.7%, meaning they're adding about 2.2% to the key policy rate. Why is this important? Well, inflation, if it keeps going down and the economy keeps softening, you can potentially see an interest rate cut coming maybe in Q3 or Q4 of 2023. However, the banks in the US and in Canada are saying there's never going to be a rate cut in 2023. Don't even think about it. But the reason they have to say that is because they can't unanchor inflation expectations. If people, the consumers, start thinking that the Bank of Canada and the US Fed are going to drop rates, well, that's going to give them confidence to start purchasing again and start borrowing money because they feel like interest rates are going to come down. And that's going to completely reverse all the fighting they've done against inflation so far. So no matter what, they have to tell the public, don't worry, guys. We're not going to lower rates because we're not going to do that potentially until Q1 or Q2 of 2024. But if we enter into economic softening to a point where the economy is really starting to suffer, you're likely going to see an interest rate cut. So if they start cutting those rates, for example, if they go from 4.5% down to 4, that prime rate is going to at least fall by 0.5%. So that's how that all works out. Next thing I want to cover is the actual inflation numbers by Canada, by the Canadian economy. So here's a graph that represents our inflation in Canada. This is coming right from the Bank of Canada's website. In June of 2022, we were at 8.1%. And as you can see, we've fallen all the way down to 4.3% right now. This gray area, as according to the legend right here, is the Bank of Canada's target zone of inflation. So essentially, they want inflation between 3 and 1%. And we're finally getting pretty close. We're 1.3% away to start entering that zone, that key target range for the Bank of Canada. So that is a positive sign. And with crude oil just recently falling, I believe it was at $68 the last time I checked, that oil cost coming down is going to essentially bleed into a lot of other goods and services because the cost of fuel is a huge input cost in a lot of different manufacturing and transportation costs. So if gas and oil get cheaper, that's probably going to help drive inflation down even lower moving forward. To keep going on this inflation macroeconomic viewpoint here, the next numbers that we're going to get for Canada is on May 16th. And on May 16th, we're going to get the April numbers and see how inflation did in April. So hopefully we continue seeing that trend coming down, and that's going to be really good for the real estate market and buying confidence, because that's going to hopefully lead to interest rate cuts in the future. The 5-year bond yields are holding steady down at 2.8%. So that's going to be a key number that we're going to look at when we're talking about interest rates. That's also positive. And yeah, that's essentially, I have some other things here, but we don't have to get into too much detail. There's some really good articles about how inflation is coming down. There's some fear-based articles as well. How the Toronto Star wrote a piece on like how prices are dropping 20%, et cetera, et cetera. Yes, that is true year over year. So because essentially right now we were at the height of the market in 2022. 2022, in this month, we were at the very, very peak of the market. And right now, yes, real estate has come down year over year, but smart buyers and the people that are really looking at the real estate market are not looking at the year over year trends. They're looking at the month over month trends. Is the market stable? Let's not look at what happened last year this time and say that the market's down 20% to be a clickbait article. But let's take a look at what's happening month over month. Is there stability? Is the market going up? Do we have inventory? All that fun stuff. So we're going to get into that right now. I just want to give you a brief overview and how that's likely going to connect into the real estate market moving forward. All right, let's jump into the next slides. Okay, let's do a super quick interest rate update here and explain exactly what's going on here. So over the last 4 months, you can see that interest rates have held pretty steady. In February, we're at 4.44%, and now the best 5-year fixed rate you can get is 4.29%. So the way the 5-year fixed rates work is that there's a spread. So again, interest rates being added on top of another number is how we make up the 5-year fixed rate. So for example, the 5-year bonds are about 2.89 to around 3%. That's where they've been over the last 4 months. And the banks usually want to see a 1.5% spread between the bond yield and what they're going to be offering customers on the open market for 5-year fixed. So anytime a spread gets closer to 1%, that's a key indicator that interest rates are going to go up. Anytime the spread gets up to 2%, that's a great indicator that interest rates are going to go down. So as you can see here, we've been holding pretty steady, and the banks are getting a little bit more aggressive on their spread, so to offer to customers to potentially win business. So as you can see, the spread has been around 1.5% steady over the last 4 months, and interest rates have been coming down to 4.29%. So right now, a 4.295% fix is not a crazy interest rate, and historically has been a very typical interest rate. That is why you're going to see in the later slides that the real estate purchasing has been picking up. All right, that's a good enough overview on that. And as you can see here, the 5-year variable is still at 5.55%, which is actually above of where the fixed is. And usually the fixed, as you can see, is usually higher than the variable. So again, a great time to get into fixed mortgage product. If you have any questions, please feel to reach out about that. All right, let's flip on to the next thing. All right, let's do a quick overview on the whole real estate market and exactly what's happening. So green line represents how many homes are coming into the market. Red line represents how many homes are leaving the market. And the red line's made up of 2 lines here. It's made up the orange line and the blue line. Orange line is how many homes have sold, and the blue line is how many homes failed to sell. So sold homes plus how many homes failed to sell is the total of how many homes left the marketplace. As you can see, already in April, more homes left the market than actually entered the marketplace, which isn't a great indicator for home buyers out there, because that means there's less inventory on the market, inventory is dwindling, and interest rates are actually stabilizing, and buying activity is actually increasing, right? As you can see here, buying activity has really increased and has held pretty stable over the last 2 months. March was 185 units, and April was 180 units sold. Where the inventory actually is coming down. Okay, so as you can see here in the total market overview, we have 842 homes coming into the marketplace in 2023, and 603 sold, and 219 failed to sell, which added an excess of 20 homes. Just 20 homes got added, when typically at this time of the year, we have 100 or 200 homes being added to the marketplace because of the inflow of listings. So we don't have a lot of listings here. And I really feel like if we don't get more listings soon, this is going to be a negative number really quick, meaning we're losing inventory in the overall marketplace. As you can see here, these numbers are pretty big. 25% less inflow over our 5-year average and 36% inflow versus last year. For our sales, we had 25% less homes coming to the market or selling versus our 5-year, and 30% less homes selling over last year. The fail to sell actually is right back to stable numbers. Only 11% more homes are failing to sell this year over a 5-year average. And actually, it's 8% better this year than last year. So that's really stabilized. And looking at what type of market it is, well, right now there's only 184 homes on the market. And if we're only adding 7.4 homes to the market every single day and 6 homes are selling every single day, that means we're only going to have 227 homes left in 30 days. And if 6 homes sell every single day and no new homes come onto the market, that's called absorption rate. How long does it take until we run out of homes? We run out of homes in 1.26 months. Yes, in the crazy times, it was less than half a month's of inventory or less than 1 month inventory. That was when the market was at its peak. But again, we have dropped from 3 months of inventory to 1.26 of months inventory in just a matter of months. So really that's showing that the buying activity is picking up, and we're going to get into that more into the other slides. Okay, let's quickly now look at what's going on a quarter basis here and kind of show you what's happening. Okay, so on a quarterly basis here, list price to sale price ratio, quarterly days on market. Here we go. So quarterly days on market in Q1 ended at 21 days on market. And then in Q4, we were actually at 29. So a meaningful drop again in days on market, indicating that the market is heating up. And again, in Q2, we've only have 1 month of Q2 data. We can already see how the market is heating up. 16 days in the month of April is what it took to sell a home. Now let's look at quarterly list price to sale price ratio. So that's the difference between what a home lists for and what a home sells for. In Q4, it was at 96.1%, and in Q1, it was at 96.2%. So it didn't slide, it didn't drop, it held steady and slightly increased. But you can see that in April of 2023, the list price to sale price ratio is already 101%, which is showing that there's a lot of buying activity and multiple offers are now back. And they might be back to stay if we don't get more inventory. Another quarterly report that I want to show you here is the quarterly average price. As you can see here, in Q4 of 2022, we were at a $741,000 average sale price. And then in 2023, Q1, we are at $752,000, which shows that we've been absolutely stable for 6 months almost. And that's something I'm going to show out in the monthly as well. Okay, so that's kind of your quarterly overview, and now we're going to flip over to the monthly and show you what's going on in the market. All right, let's get to it here. So as you can see here for the inventory check, our 5-year average for how many homes we typically have on the market at this time is 270 homes. And currently we only have 184. And out of those 184, 28 are actually conditionally sold, which means there's only really 156 homes left for purchasing. From single family homes, we have 154 typically on the market at this time. We only have 104 now. Semis are at 6 versus the 15 that we typically have. Towns are down to 32 versus the 53. And condos are actually pretty close to their 5-year average of 42 instead of 49. Another interesting thing here, I mean, I've never seen such a flat inventory curve in a very long time. So even last year, we actually had a spike of inventory come up when everything was getting gobbled up so fast that it wasn't even staying on the market. But even in last year's time, we had a little peak come up in the inventory, and this year it's just a flat line. And I'll show you why that we're running a flat line in inventory right now. So for new listings coming to the market, in the month of April, we had 223 homes come to the market, which sounds good, but that's only 7.4 homes a day when we typically get 10.8 homes a day. So as you can see, we're down 31% from our listings coming to the market. And as you can see, and we already covered the broader overview that we're around 30% down, every month is around typically 30% down, and here's another one, right? And then for our outflow, for how many homes are leaving the market in sold capacity, look at this. We've actually increased pace quite significantly, right? So 27% less sales, 30% less sales, 25% less sales. Here we have 18% less sales. I know it's still less sales, but quite significantly a pickup in typical inventory, typical buying. So we had 180 homes sold last month in April, and our seasonality in April is 229, which is actually lower than a month of March, which is at 244. So we were actually getting pretty close to our typical outflow of sold homes. So you can see less listings coming to the market, but buying pressure is increasing, right? So that's not going to be good for people sitting on the fence. While everyone else is gobbling up inventory, you're just going to see the prices kind of go up without you. Next thing we want to look at here is failed sales. And for the first month, we actually had a negative number, which is actually positive for failed sales, right? Because if you have a ton of failed sales and the number increases, like for example, 50% more homes fail to sell, that's actually a negative. And if you had less homes fail to sell, that's a positive. So actually, we saw only 2.1 homes fail to sell a day. And our typical for this time of the year is for a 5-year average is 2.5. And last year, this is when this is when inflation was starting to poke its head out and things were starting to turn in the real estate market, because April in Guelph was the absolute peak. And then we went for almost a 30% crash in the next 4 months thereafter. And this is the first indicator that you really saw there, was that the failed home sales were really starting to pick up. Okay, jumping over into the sold listings days on average. So as you can see here, you know, August, which is where we were, the lowest average sale price was happening. September, all was like 29, 30 days on market. And look at this, we're already picking up steam and only at 16 days on market for homes to sell, which is an incredible pickup in pace. List price to sale price ratio. As you can see here again, for the first part of the year, besides March was a little anomaly there, where it was about 93% list price to sale price ratio, but all the other months were right around 100%, and April saw 101%. That's the first time we've seen over 100% in what, 8-9 months? So 8, 9, 10. In 10 months. We haven't seen 100% list price to sale price ratio in over 8 months or 10 months, whatever I just said there. So things are really starting to turn around in the real estate market again, it looks like. And now let's take a look at the monthly average sold price. And this is where I like to spend a little bit of time with everyone because it really does show the trends of what's happening here. See, in 2017, we had an average sale price of $562,000. That was the peak in 2017. And then the Bank of Canada came in, tightened monetary policy, foreign buyers taxes, etc. Key lending rate increases. So to qualify for mortgage, that increased. And that really drove the market down almost 18%. To August low of $460,000. It took 34 months for the market to recover back to its peak pricing in 2020 February. That's when the first time average sale price actually exceeded that in 2017. Why am I telling you that? Well, I want to draw a parallel to what happened in 2022 and really show you that, you know, the market could be recovering and it may recover quicker than it did from 2017 to 2020. So here in April, we hit our absolute peak. We hit $1 million average sale price. And then we saw a 27% drop, 28% drop from April to January 2023. But the biggest drop happened from April to November. The market dropped 26%. And from that point on, from after November, so December, November, January, February, March, that it was about 2% drop from there. But here's the crazy part. Just in February, we saw a little bump, 6.6%, and then March went back down to 756. As you can see here, though, 748,000 all the way to here to March. I mean, that's a very stable zone. I mean, the market really stabilized, and interest rates stabilized, inflation's starting to come down. So there's a storm brewing, right? And I was talking about this back in November, December, when I started seeing the stability. I was like, guys, I mean, this looks like a really good market opportunity. I think we're close to the bottom. And I said that in November, that I believe we were getting close to the bottom. And really, it didn't go much lower. It went to 720 in January, which one of the seasonality is one of the lowest markets. But you really start seeing these trends play out, and you can really identify really good purchasing opportunities. Anyone that bought in January or back here is laughing right now because in April, the average sale price jumped to $825,000. I know that's only 1 month, and it's not, 1 month doesn't make the whole year, but it really does show that the trend was reversing, right? Because we saw a lot of stability in the average sale price. We saw stability in the list price to sale price ratio. Days on market was stabilizing. And now the average sale price was stabilizing for a while, interest rates, etc. And now we had this moment where the market just seemed to flip, right? Multiple offers are happening, list price to sale price ratio of above 100%. And now this, an $825,000 average sale price, which is up 9% from the previous month. So if that pace continues, we can really see that there's going to be a nice recovery in the marketplace. Typically what happens after this, in 2018, we had a completely flat year. And I was kind of thinking we were going to have a pretty flat year this year, but I wasn't expecting such a low amount of inventory coming to the market. And if inventory stays this low and interest rates start coming down even further, then we could probably see average sale pricing increase even faster. Okay, so that's my 2 cents on that. You could agree or disagree with it. I'd love for you to leave a comment in the video below. Reach out to us if you want to talk about the real estate market and how your home might be valued in today's market and how we would position it to sell successfully, and how we would set you up on a proper buying strategy so you can win in multiple offers, because it looks like you might have to do that again here. And our clients succeeded so many times in multiple offers because they did the right steps and prepared themselves for success. All right, well, that's pretty much all I have to cover with you today. If you have any questions, please feel free to reach out to the Zahnd team. I hope you enjoyed this market update, and I will see you at the next one. Talk to you soon. Bye.